Over the past year, one stock that has absolutely exploded that everyone is aware of is Tesla, stock ticker TSLA. It's up over 1,100% over the past 10 years, but they have been struggling over the past year, down around 6%. Now, the company is currently trading $172.14 per share, and in this video, we want to see if we can find out how much free cash flow growth is priced into this company. Now, typically when you value a company, one of the most popular ways to do that is to perform a discounted cash flow analysis. And essentially what that does is you find out how much a company is worth based on how much free cash flow they're going to produce in the future. But in this scenario, we want to find out how much growth is priced into the company, so we're going to use what is known as a reverse discounted cash flow analysis model. So basically what that means is we want to see what free cash flow growth rate does the company have to achieve in order to get to its current share price. And for example, as of right now, if we assume 0% free cash flow growth, the reverse discounted cash flow price per share would be around $21.81. So with no free cash flow growth, that is how much the company would currently be worth. But the company is currently trading at $172.15 per share. So let's figure out how much growth is priced into this company. Now, historically speaking, 10% free cash flow growth is pretty solid. So let's go ahead and start there and plug in 10%, and we can see that bumps our reverse DCF price per share up to around $41, still pretty far off from that current trading price. Let's go ahead and bump this all the way up to 20% free cash flow growth. We can see the reverse DCF price per share gets us to around $78.66, so we're still pretty far away. So let's make another large jump up to around 30%. We can see now we're starting to get closer, as if we get 30% free cash flow growth over the next 10 years for this company, we come to a reverse DCF price per share of around $149.45. So we're still not at the current price, and we can see there is just a ridiculous amount of free cash flow growth priced into this company. Let's bump it up to around 31%. We can see we're getting closer. 32%, we can see we're now very close. If we bump it up just a little bit higher, let's say 32.25%, we can see we get to our reverse discounted cash flow price per share of $172.15, which is also the exact trading price for this company. So it's pretty mind-blowing to believe that over the past year being down 6% and year to date being down almost 31%, this company still has 32.25% free cash flow growth priced in over the next 10 years. So when using a reverse discounted cash flow analysis, after you find the free cash flow growth rate projection, basically the question you need to ask yourself is that free cash flow growth rate justified? Do you think it will be higher or lower? If you think they'll achieve higher free cash flow growth than the free cash flow growth rate projection, then maybe it's a company you should consider investing in. If you think there's too much free cash flow growth priced in, then it's probably a company that you want to avoid. Now, like always, this valuation model is completely automated with the ticker data function. You can see the data is automatically pulled in with ticker data, which is an extension in Google Sheets that can automatically import your data. Like always, you can download any of my spreadsheets and get access to the ticker data function by clicking on the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.